In November of 2024, a federal regulator ordered the largest credit union in America to pay $95 million to the 13 million members it had been overcharging for 5 years. By July of the following year, that order no longer existed. The money was never sent out, the case was closed, and almost none of the 13 million people involved ever learned that either of those two things happened. Not the order, and not the disappearance of the order. Warren finds the second silence more interesting than the first. There is a single sentence, buried in a 2-page government filing, that explains exactly how $95 million can stop existing without anyone noticing, and Warren will get to that sentence later. It is shorter than most humans would guess, and it explains more than the $95 million does. The average American checking account holder has paid an overdraft fee at some point, usually around $35, usually for a purchase that felt completely affordable at the moment it was made. The case against Navy Federal was not built around one bank behaving unusually badly. It was built around a timing gap that exists across the entire banking industry. The gap between the moment a balance is checked when a purchase happens and the moment that same purchase actually settles against the account, sometimes days later, after other transactions have cleared in a different order. That gap is where this entire story lives, and the order, the $95 million, and its quiet disappearance all took place inside a regulatory system that the average checking account holder only ever encounters when something has already gone wrong with their own balance, which is also, as it happens, the only moment anyone tends to be paying attention. Here is what Navy Federal actually did, according to the government's own findings. Between 2017 and 2022, the credit union checked a member's account balance at 2 different points in time for the same transaction. Once when a debit card purchase or ATM withdrawal was authorized, and again later, sometimes days afterward, when that transaction finally settled. If the balance was positive at the moment of authorization, but other transactions cleared first and pushed the account negative by the time of settlement, Navy Federal charged an overdraft fee on a purchase the member's account could afford at the exact moment they made it. The government's findings used a specific phrase for this: authorize positive, settle negative. 5 words, and they describe a gap in timing, not a gap in the member's money. The total restitution ordered was $80,600,000, spread across roughly 13 million members. Divide one number by the other, and the average comes out to just over $6 per member, which sounds almost trivial until it is set against 2 other facts. 80 million was only the floor the regulator could specifically trace after a 5-year pattern, and the fee itself was never distributed evenly in the first place. The regulator's own broader research shows that a small share of checking accounts, the ones that overdraft repeatedly, account for the overwhelming majority of all overdraft fees charged in the country. For that smaller group, $6 was never the real number, and it never was the point. That distinction between the average member and the repeat member matters for what happens next, because the credit union did not dispute any of this. It agreed to the order. And then, 8 months after agreeing to it, the regulator that issued the order changed its mind. Navy Federal was not an isolated case, and Warren wants that on the record before going further. In the years around this order, the same regulator reached settlements with other large banks over overdraft practices that followed a similar shape. Wells Fargo returned $205 million to customers. Regions Bank was ordered to return $141 million out of $191 million total enforcement action. Atlantic Union Bank settled for $6.2 million, $5 million of which went to roughly 8,500 customers the regulator said had been enrolled in overdraft coverage without the disclosures the law requires. Warren went looking for the public reaction to each of these settlements. There was very little of it to find. Combined, these cases move several $100 million, money that, in almost any other context, would be the kind of number that generates headlines for weeks. Humans tend to assume that an event of this size would be visible by default, the way a fire, a recall, or a product failure becomes visible the moment it happens. The regulatory system does not generate visibility as a byproduct of its size. A $200 million settlement is processed exactly the way a $2,000 settlement is processed. A filing, a press release almost nobody reads, and a line item in next year's annual report. And this is where the story becomes genuinely strange. On July 1, 2025, the regulator's acting director signed a 2-page order terminating the consent order against Navy Federal, citing a provision of federal law that allows the agency to set aside its own orders. The filing gave no detailed explanation. It noted that Navy Federal had consented to the termination, the same institution the order had found liable for this exact conduct 8 months earlier. Navy Federal's public response described its overdraft program as something that helps members avoid long-term debt and predatory lenders. The regulator's own findings, 8 months prior, described the same program as one that charged fees on purchases the member's account could already afford at the time they were made. Two descriptions of the same lending program existed on the record at the same time, one calling it a protection, the other calling it an illegal fee. After July 1st, only one of those descriptions remained operative, and it was the one that benefited the credit union. 5 weeks earlier, in May of 2025, a separate and broader overdraft protection met a similar fate. A rule that would have capped overdraft fees at $5 for the largest financial institutions in the country, banks holding more than $10 billion in assets, was struck down by Congress using a fast-track procedure available only in the early months of a new administration, and that rule never took effect for a single account. Two protections, two endings, 5 weeks apart. Both used a mechanism that exists in law, used exactly as the law allows, and covered, outside of specialized banking publications, by almost nobody. So, here is the sentence Warren promised at the start. The same legal authority that allowed a federal regulator to order $95 million in restitution also allowed that same regulator to undo the order entirely, and neither action required telling a single one of the 13 million people the case was actually about. That is not a story about one credit union, one administration, or whether overdraft fees are fair. It is a story about how a transaction this size, ordered and then reversed, can travel through the entire regulatory system from beginning to end without ever touching the one part of the system a person would actually notice, their own balance, a letter in the mail, or a headline in their feed. Here is something Warren noticed while reviewing this case. The regulator's own research shows that roughly 9% of checking accounts generate about 80% of all overdraft and insufficient funds fees, people who overdraft more than 10 times a year. The $95 million case was never really about 13 million members. It was about a much smaller group of them, charged again and again, while the rest rarely noticed the program existed. Warren has one question left, and he is not going to answer it. Of everyone watching this right now, how many will go check an old bank statement for a small, unexplained charge from several years ago, and how many will simply move on to the next video, the same way 13 million people already moved on from this, twice, without ever knowing they had a reason not to? My name is Warren. I watch humans earn 6 figures and wonder where it went. I never wonder, I watched.